When it comes to building wealth, index funds are one of the most powerful tools that have ever been created. You know, everyone says invest in index funds, and it's for a very, very good reason. Personally, I've been using index funds to grow my wealth for a number of years now. But here's the thing, the difference between investing well and retiring early and making some mistakes and delaying your retirement can be massive. So in this video, I'm going to break down 7 mistakes that I've seen investors make, and a lot of them even still do till today. And most importantly, I'll show you how to avoid them so you don't fall into those same traps. With all that said, let's get into it. The first and the most dangerous mistake is chasing past performance. Most investors understandably look at past returns, including myself, when we are picking a fund. You want to see how this fund has performed in the past. If a fund has performed well, it should keep performing, right? Wrong. Many new investors don't know that there was a time that Japan was the economic powerhouse of the world, and investors from across the world rushed into Japan's index funds, and they were expecting endless growth, profits. By 1989, Japan made up a staggering 45% of the global stock market. This is larger than the US at the time. Companies like Sony, Honda, Fujitsu, they were the equivalent of today's Apple, Amazon, and Microsoft. Yes, they were that big. But then what happened? A crash happened, and Japan's market declined by more than 80%. Yes, 80%. Even today, as I'm talking to you, more than 30 years later, the Nikkei 225 has still not recovered fully to its 1989 peak. Just imagine investors at that time diversified into a global index fund that included other countries. They could have avoided this disaster. Another example is the dot-com crash, right? So this is not focused on a particular country like Japan, but focused on a particular sector. Chasing past performance can lead to 3 major problems. 1, you end up buying high and selling low, because investors will get excited at the peak when the stocks are high, and they will buy, and then they will panic sell when things go bad, which they will happen. Number 2 is ignoring market cycles. Every sector, every region has something called the boom and bust. The bear and bull market is bound to happen. And then missing true diversification. If you rush into one sector, one country, you're going to miss diversifying your investments. So how do you avoid this? 1, you need to look beyond past return. There's a reason why most platforms, when you look at their funds, will tell you past performance is not an indication of future performance. You need to consider things like the fund's holding, valuation, and also the current market cycle. Also, you need to understand why a fund is performing well. You need to know the basics of that fund. Why is it performing well? Is this fund fundamentally strong? These are the questions you want to ask. Also, diversify across different index funds. This is how to beat this bias, or just buy a global index fund. And lastly, set a strategy, stick to it rather than chasing short-term trends, because what worked yesterday might not necessarily work tomorrow. It's good to remember that. But do you want to know what would always work? Yes, that's liking this video. Yes, thank you so much. It's a small act on your part, but a massive boost for us. So thank you. We really do appreciate that. The second deadly mistake that I've seen a lot of investors make is the fact that they panic sell during market crash. And the truth is, yes, I get it. Watching your portfolio drop 20-30% is actually terrifying. But here is what most people don't realize. It's normal. Market crashes are completely normal. The stock market always has ups and downs. That's constant. In fact, they are actually essential, these ups and downs, for long-term growth. The real mistake is selling at the bottom and locking in those losses. Just look at what happened to investors who sold in a panic in the March of 2020. I remember a friend called me at that time and I told him, no, don't sell, you're in it for the long haul. And what happened? A lot of them missed out on the fastest recoveries in history. So how do you avoid this? One, stay invested, trust the process, trust long-term growth of the markets. Understand that market corrections are normal. You need to understand this. It's not fun at the time, but remember, market corrections are normal. Mistake number 3 is holding too many niche or thematic ETFs. The word there is too much. There is a rise, and it keeps growing, of sector-specific ETFs, chasing and tempting us with the latest trends. AI funds, clean energy, cyber security, this, that. A lot of ETFs are popping out left, right, center. But here's the truth. These high-risk specialized funds often underperform boring old market index. You should only invest in these specific ETFs unless you have a deep knowledge of that sector, that specific sector. If not, just stick to a broad-based index fund. The fourth mistake is sneakier than many people realize, and that is overlapping index funds. You think that you're actually diversified because you own multiple index funds, right? Well, think again, because in reality, you might just be doubling up on the same companies without actually realizing it. Let me show you what I mean. So, for example, your favorite Instagram personal finance influencer, right, tells you to buy VUSA and QQQ, which is the Vanguard S&P 500 and Invesco Nasdaq 100 ETF. And that sounds like a smart combo. They say do 60% VUSA and 40% Nasdaq. But if you own both funds, you're actually overweight in the same US stocks, especially tech giants like Amazon, Microsoft, Apple, and Google. VUSA tracks the S&P 500, which is the top 500 US companies. And the QQQ tracks the Nasdaq 100, which is heavily concentrated US tech stocks. So this means that you're taking on more risk than you actually realize, because if tech stocks drop, both funds will suffer, and you're paying extra fees for the privilege without actually gaining more diversification. So maybe for that advice, instead of adding multiple US focused index funds, consider a global index fund to truly diversify, or buy an international fund that is based on your predetermined asset allocation. Mistake number 5 is not checking the key investor information document, or KID as I call it. And this is what the document looks like. I know it looks boring, I know, but just bear with me. Ignoring these documents could mean that you're missing out on important information. And as the pilot says, you're flying blind. Here's the perfect example. The MSCI World Index sounds like it covers the whole world, right? Wrong. Because even though it mentions world, it completely excludes emerging markets like China, India, Brazil. And those countries have potential huge growth that you're actually missing on. While the FTSE All World Index, remember this has world again, includes developing countries like we mentioned before. So while one doesn't have developing, another one has developing. But you can't see this full picture if you don't look at the KID document. Mistake number 6 is focusing only on fees without context. I know that one of the things I've advised is look at fees, and fees are important, but they are not the only factors to consider when picking an index fund or when investing in an index fund. Yes, you might have a low-cost fund, and these funds tend to outperform expensive ones. A study by Morningstar found that low-cost funds be high cost over time, right? But just because a fund has low fees doesn't make it the best choice. You also want to consider diversification. You want to consider performance consistency, the standard deviation. You want to consider risk exposure. Don't fall into the trap of choosing a fund just because it's cheap. Make sure it is actually a strong investment. And there are lots of strong investments and strong funds that are actually low cost. So don't get that twisted. And finally, mistake number 7 is choosing the wrong type of index funds. Not all index funds handle dividends the same way. Let me explain. There is a difference between accumulating and distributing funds, and you will always see it in their name: accumulating, distributing. Accumulating funds automatically reinvest your dividends or your returns, while distributing funds pay out the cash into your account. Many investors accidentally choose a distributing funds without reinvesting the dividend, losing out on compound interest and on compound growth. They don't know any better. They think the fund automatically invests, but it is not. It's a distributing choice, not an accumulating fund. And if you're looking at investing for the long term, you need to invest in an accumulating fund. So that's it. The 7 deadly mistakes that could be killing your wealth right now. Let's do a quick recap, right? 1 will be: don't chase past performance alone. Avoid panic selling during crashes. Be careful with niche ETFs. Watch out for fund overlap. Always read the key documents. Look beyond just fees and choose the right type of fund for you. And remember, investing doesn't have to be complicated, but these simple mistakes can have huge consequences. If you want to learn more about investing, check the link in the description to sign up to our newsletter, and we have a free investing ebook for you. Subscribe for more like this and drop a comment to tell me which mistake actually surprised you the most. And I'll see you in the next one.